Hi there, this is Isabel Valley CPA, and I have a question for you. What if your biggest expense isn't your rent or inventory, but something hiding in plain sight? Most people spend about 25 to 32% of their income on it without realizing there's a way out. I'm talking about taxes, and contrary to what you might believe, online sellers have access to 3 secret hacks that can dramatically slash what they owe. Today, I will reveal these 3 hacks. This advice is like free money. We charge thousands for this advice. So if you're watching this, consider yourself right now at the right place at the right time. So here are the 3 hacks, and you may want to stick around because that last hack, that might be the most powerful one yet. So stick around for that one. Here are the 3 categories that give you extreme opportunity to either eliminate or greatly reduce your tax bill as an online seller. And let me go ahead and start this because I did a little presentation for you. All right. Now, here are the 3 areas where, as an online seller, you can experience some pretty profound tax savings. And it is very specific to online sellers. The very first one is depreciation. The next one we're going to cover is about inventory. And lastly, but not least, and this is the big one, is when you sell your business. All right. First is depreciation, or shall I call it accelerated depreciation. As of a few weeks ago, they increased the rates in which you can apply 2 types of depreciation strategies. One is called bonus depreciation, which as of a few weeks ago should have been 40% of the assets you purchase that were eligible to be depreciated in 1 year. Now it's 100%. So 100% of the assets that once were depreciated can now be expensed in 1 year. The next type of depreciation treatment is called Section 179, which this year was increased to a whopping $1.25 million of assets that can be depreciated all in 1 year, versus where assets used to be depreciated between 5 to 39 years. So if you bought something today, it would take you 5 to almost 39 years to go ahead and take the expense. And as you know, the more expense you have, the lower your tax bill. So imagine now being able to expense all of it, all of these purchases in 1 single tax year. So let's take a deeper dive into the differences between Section 179 and bonus, and how they can use one or the other or both in 1 single tax year. First is Section 179. Think of Section 179 as a special rule from the IRS. It lets you subtract or deduct certain costs for things that you buy for your business, specifically assets like warehouse equipment or vehicles. But there are some limits to Section 179. First of all, it's limited to $1.25 or $1,250,000. If you spend more than $3,130,000 on equipment that year, your deduction starts to shrink. And if you even buy more than $4,380, you can't take any Section 179 deduction at all. So the more equipment you buy, essentially reduces the ability to take the 179, Section 179 deduction. But as long as you buy 1.125 or $1,125,000 worth of assets, you can deduct all that in 1 year. Not 5, not 7, not 15, not 39, 1. Now, Section 179 also can't create a loss. So what does that mean? So what it means is if you don't have enough business income to use the whole deduction this year, you can't you can't use it. You can use only up to how much you make, and you can carry what's left over for future years. So here's an example. Imagine you buy a forklift for your warehouse and it's $50,000 and your business only made $50,000 of net profit this year. Well, that means you can deduct the entire $50,000 right away and save on your taxes. So before, you would have to pay taxes on the $50,000 that you netted, the net income that you made. But if you purchase let's say in this example, a forklift that costs $50,000, you can deduct the net income that you made from the $50,000 and have zero net income. Now, but let's say if your business only made $20,000, right? Well, then if your business only made, and by the way, here's my little sidekick today. I don't know if you guys like little white mischievous dogs, but that's who's here right now. So going back, so let's say your business only made $20,000 this year, right? And you bought a $50,000 forklift, right? Well, this year you can only deduct $20,000 of the 50. So you can only deduct as much as you profit using Section 179. You cannot put yourself at a loss. You can put yourself at a zero net income, but you can't be a negative. So hopefully that is clear. But what about this other guy, bonus? So bonus works a bit differently. It's another IRS rule that lets you deduct the entire cost of qualifying items right away without a yearly limit like Section 179. So in 2025, the rate is 100%. It was going to be 40, but as of a few weeks ago, it went to 100%, meaning you could fully deduct the cost of equipment you bought that year, even if it means your business shows a loss, unlike the Section 179. So here's an example. Let's say you bought a warehouse shelves and conveyor belts for $200,000. Under bonus depreciation, you can deduct the entire $200,000 from your income immediately, even if it results in a business loss this year. Now, what if you combine both the Section 179 and the bonus? You can, if you want to, in 1 year. And here's how it works in real life. Imagine your online store buys a delivery van, like an SUV of some kind, for like say $45,000. With Section 179, you can deduct up to $31,300 for an SUV like this or a van like this. Then you can also tack on the bonus depreciation, which is $8,000, and that's what the cap is on bonus. And that means you can take from this $45,000 van that you just purchased, you can deduct $39,300. Now, some of you are wondering, hey, wait a minute, you just said I could buy $1.25 million worth of assets and I can deduct it, or I can deduct 100% if I use bonus. You can for certain assets. For vehicles, there's limitations. For SUVs, it's $31,300 under Section 179. And for standard vehicles that are not over 6,000 pounds, it's $12,200. But you could also add to that the bonus depreciation of $8,000 on both of those. Okay, so another thing that I wanted to show you about bonus, and I love using this with bonus depreciation, so I was so excited when they gave back the 100%. Here's an example. Let's say you own two businesses. Okay, work with me here. You own two businesses and both of them are making money, right? So on the tax return, you have to pay taxes on both of those businesses' profits, right? Because the tax return takes all your income sources and puts it into one big number and then charges you taxes on it, right? And depending on how much you make, the higher you make, the higher your tax bracket, the higher the percentage of taxes you pay. But let's say you buy an expensive warehouse equipment this year for $500,000, 500,000, and your online store only makes 200,000, right? Using bonus, you can deduct the entire 500,000 and you create this loss, right? Now, if you have income from another business, or let's say you have a W-2 income, right? Your wife might have a W-2 income. Well, that $300,000 loss can offset the other income source, making your taxes nothing, right? Because you can have a loss, and it could make your taxes nothing. So lowering this lowers the amount of taxes you owe on your total income, because if you have a big loss, you could use that to offset the others. Love bonus. It's a powerful tool to help you save money. Now you know how the wealthy do not pay taxes. They use this a lot. Okay. So just a big recap. Which one should you use? You can use Section 179 when your business is profitable and you want to control how much you deduct. You can use bonus if you need bigger deductions without any limits, or if you're okay with showing a loss to lower your overall tax bill. But often the smartest choice is to maximize on both. All right, so let's go on to the next strategy. Oh, wait, these are honorable mentions. I should say this. This year, there was two very interesting changes to our tax law. One is you can now deduct research and development expenses fully in the year they happen. Before, you had to wait 5 years. You can only take one fifth for 5 years for the expense to reduce your taxes. You can take the whole thing this year. So if you're testing some new AI integration or developing a new formula for something, formula for a new supplement or something, that all counts and you can deduct the whole thing this year. Now, here's the big whammy. Here's the one that I'm like, wow, incredible. This year, if you purchase a building or you actually construct a building used for manufacturing or warehousing, you no longer have to wait 39 years to depreciate that thing. You can take the whole cost this year, if it's placed in service this year, and if it meets these qualified property standards, which I don't want to get into because they're very, very, very long, but you can take that whole cost this year and really not pay any taxes. So now let's go on to the second category of tax reduction, and that is inventory. Now there's both short-term strategy and long-term strategy for inventory. So let's cover this short-term strategy. So first is timing of your sales and purchase of inventory. Did you know that selling inventory and getting paid before you deliver the inventory allows you to collect the cash, but not have to pay taxes on that revenue until the following year? For example, let's say you sell mugs online and you get paid. They make the order and you get paid, but you don't deliver the goods until January of 2026. You sell in 2025, you get the money, but you don't deliver it until January 2026. You don't have to pay taxes on that sale until 2026. So that means that you got the money in 2025, but you don't have to pay it until after 2026. Now, another strategy is to account for shrinkage, obsolete, or damaged items. A lot of people miss this because a lot of times Ecom sellers especially when they're first starting off, have a mess of inventory. They usually try to track it on spreadsheets. And if you were around last week when I talked about the holy grail of tech stacks, you would see that I am very adamant about inventory software, because there's so much money, especially from a tax strategy, to gain if you have the right systems in place that are that's tracking your inventory. So first, if you can write off old, damaged, or unsellable inventory sitting in your warehouse, if you know about it, right? And you have a valuation to it. So let's say you sell clothing online and you got boxes of sweaters from last winter that nobody wants. If you if you donate those sweaters and sell them at a huge discount before year end, you can write off the loss. That means you pay less in taxes this year. Then there's also year-end inventory counts and shrinkage. So if you do a year-end inventory count, which I highly recommend that you do, if some of your products went missing, and a lot of them do, it's amazing what goes missing, what a percentage goes missing, or got damaged during the year, which you did not realize. Also, this helps tremendously when you're trying to reorder, because then you know exactly what you need to reorder. So I advise doing it before. Not just once a year, but multiple times throughout the year, at least once every quarter, just to make sure that you have the right inventory on hand. And this is called shrinkage, when when these products go missing or get damaged, and you can deduct those costs right now, reducing your taxes. There's another big mistake that a lot of online sellers or ecom business owners make. And that is, they capitalize things in inventory that they don't need to. So why is that bad? Well, when you capitalize things in inventory, you typically only get to recognize that expense when you sell the thing. So all this money you're dishing out and you're letting it sit in a place where you can't use it as an expense until you sell the product. So it's a lot of cash going out, and you are, and then you have to come up with cash to pay your taxes, right? So you want expense to reduce your taxes. And if you're taking things that you're paying for and you're not using it as an expense, you're capitalizing it, then you're not taking advantage of tax reduction. But a lot of online business owners, they put in inventory a lot of expense that isn't inventory related. So, and know this, aside from like literal freight and other things like purchasing department salaries and quality inspections and repackaging costs, and if you're subject to UniCap, which I'm going to cover in a minute, a lot of this should be capitalized. So a lot of these you have to take as inventory. But and this is where you can expense things instead of waiting for the sale to expense them. If you establish that certain activities occurred after the inventory is ready for sale, for example, repackaging from bulk to kits. So if you're kitting, you really need to look at this, because a lot of sellers that I work with, they're kitting. And what that means is there's an opportunity to expense all of the kitting costs as and you specialize it, you distinguish it as a distinct operation, and you treat it as a separate process, and you expense it right away instead of capitalizing it as an inventory overhead expense. Most e-commerce sellers do not know this, and you need to have good accounting to figure that out. Most e-com companies will simply capitalize what's required up until the product is at their warehouse and ready for listing online. Now, I want to talk about this UniCap. So don't forget the UniCap that I just said, which is you have to capitalize things like purchasing, department salaries, and quality inspection, repackaging costs. Because there is a way to opt out of that if you are a business that makes less than $31 million a year. And a lot of us do. A lot of my smaller clients make less than 31 million a year, and they qualify to opt out of UniCap. So that means that instead of being forced to capitalize warehousing and handling costs and all that into their inventory value, they can elect to opt out, and they can actually take some of these indirect costs and expense them immediately as a period expense. This means expenses like warehouse rent, labor, certain labor, and storage utilities are no longer tied up in inventory. They can be expensed right away. So more expenses, less tax, right? Easy math, right? Now there's another election, okay, that is called NIMS. And that takes opting out of UniCap a step further. But NIMS comes into play with our next lineup, which is long-term strategies for inventory to assist with tax reduction. First is going from accrual to cash. So in accrual accounting, what happens is you can only put on your tax return the sales that comes in, right, when the sale is made, and the cost of that sale when the sale is made. Okay, so it has nothing to do with when cash happens. Cash is a different animal. Cash, you can make a sale and not even get cash. And you can purchase inventory, right, but not get to use it as an expense unless a sale happens. That's accrual accounting. Has nothing to do with when you get cash or when you pay for things. It is literally based off of an event. So the event is I made a sale, right? I haven't gotten paid yet, but I have to record it as revenue. And I sold inventory that I purchased 6 months ago. Well, now because you sold it, you can recognize the expense. But if you change to cash, it's a different story. And right now, if you have less than 30 million in sales, you can use this simpler accounting rule that lets you deduct expenses faster and pay taxes only when customers actually pay you. So you don't have to pay on the revenue until you actually get the cash in hand. For example, let's say if you sell kitchen supplies online using the cash method, and the customer order and the customer, let's say the customer orders this kitchen supply coffee maker, let's say in December, but pays in January, you don't owe taxes on the sale until next year, right? It's an easy way to keep more money in your pocket. And also, here it is, if you elect the NIMS, remember the NIMS? I was saying, hey, this is like a step further from the opt-out on the UniCap. The NIMS method, and only applies to those that are making less than 31 million a year. And when I say making, I mean selling, not netting, selling 31 million a year. Inventory costs are treated like supplies, and they are deducted once the item is sold, that is delivered to the customer. So what does that mean? I'll tell you. So here's an example. Let's say you purchase the kitchen supply, right? And you sell online in December, and you provide the item to the customer in December. You can take the cost of that item as an expense in December. So here you go. You shipped it to the customer, right? But you haven't actually gotten the money yet, right? Let's say PayPal hasn't paid you yet, or Amazon's taken 2 weeks to give you the money, right? So in December, you can expense it out because you're on the cash basis. And also under NIMS, which is very similar to the opting out of the UniCap, all the direct labor and the indirect costs that used to be capitalized for anybody else, you can actually take that in the current year when you pay it. So you could just deduct it right there, that current year. You have to capitalize it. The only thing that really goes into like your inventory is like direct material costs. Okay, so all that other foo-foo stuff that they have, you can expense that if you elect this NIMS. So going back to my example, you sell it online in December and you provide it, you actually deliver it to the customer, but you don't actually get the cash until the following tax year, January, right? So the December tax year, you may pay far less in taxes as you have ample expense to write off your taxes because you're taking all the expense for that particular product that year. And you don't have the revenue to offset it, right? So your net income is very, very low because no revenue, but all the expense. And the revenue will come the following tax year when the customer pays you. So there is that beauty of cash accounting versus accrual. You take the expense one year, make your tax really, really low, and you can wait till the following year before you actually have to recognize the sale. Now, of course, the following year, that's something else you got to think of because you are going to have high income that year because that's when you got paid, right? But then think of December of that year. You do the same exact strategy, and once again, it's kind of moving forward, and you might have a lot of expense, right? Especially if you sell a lot in December, but you don't actually collect the cash until the following January. All right. I hope that wasn't too complicated, and I hope you guys are still awake and not falling asleep on me, because the next one is awesome, and the one after this is like just the best. You guys really should pay attention to the one that's coming after this, okay? Now, last but not least is to go from FIFO to LIFO. So you might have heard the terms FIFO and LIFO before. FIFO means first in, first out. So if you purchased a widget before the tariffs hit, right, and you sold it, you can only expense that widget that you sold based off of the value that you purchased it. Now the tariffs hit and everything's gone up in price, right? All your expenses gone up in price. Well, with FIFO, you have to take the cheaper cost. So you still sell it, but then you have the cheaper cost and you have a lot of net income, right? But what if you decided to change from FIFO to LIFO? What is LIFO? Last in, first out. So that means, let's say your expenses skyrocketed, which for a lot of us right now, it does because of the tariffs. And I had weeks ago sessions on tariffs and how to avoid tariffs and all that. I hope you guys take a look at that. But this going to LIFO means that you sell it, right? And you can use the price or the cost that you paid for that particular item that you just recently paid. So last in, the last time you bought it, the first time you bought it, it cost $5. Tariffs hit, now you buy it, it costs $10, right? So FIFO, you have to use the $5 expense. LIFO, you can use the $10 expense for your COGS. So that lowers your taxes. The higher your expense, the lower your taxes. So there you have it. Easy tax saving strategies that if you start using today and some smart moves that'll benefit you for years, especially if you manage your inventory right, you'll keep more money in your pocket. Okay, so now the last but not least is this thing, which is the biggest tax reduction hack there is. So if you ever imagine, perhaps you want to retire and live on the beach and you build this beautiful business and now you want to sell it, and you want to sell it and you want to pay 0 taxes when you sell it, you can. So sounds amazing, right? But I'm going to tell you that it's totally possible. It happens all the time. I help my clients do this all the time. And it's based off of something called Qualified Small Business Stock, QSBS, exclusion. So what is QSBS? Well, in simpler terms, QSBS is the special tax rule that rewards business owners like yourself for building and growing small businesses, especially Ecom companies. It lets you exclude up to 100% of your gains or profits, from the sale of your company. up to, and they just increased it, it was 10, they just made it 15, $15 million does not get taxed. So that could mean that you're not going to pay any federal taxes on a big chunk of your earnings. So here's an example. Imagine you started this little online clothing brand, right? And back in 2018, right, or let's say 2020, you changed it to a C Corp, because this only applies to C Corps because it only applies to stock, right? That is a public stock, like a C Corp, not a public stock, but it's a C Corp stock. Only applies to C Corp stock. Does not apply to S Corps or LLCs. Does not apply to S Corps or LLCs. I have to say that over and over again because you have to understand it needs to be a C Corp. So if you're an S Corp right now or an LLC, and you say to yourself, you know, in 5 years, I want to go ahead and sell my business, change it to a C Corp today. Wait 5 years, and when you sell it, you don't pay any gains on $15 million worth of gains. Crazy. It's crazy. It's a crazy, crazy election, but it's there and it works. So just know that, you know, with QSBS, you pay, let's say you sell that company for $10 million, zero taxes. Without the QSBS, about a quarter of that goes to Uncle Sam. So imagine you sell something for, you work hard, you build this business, all your blood, sweat, and tears. You sell it for 10 million, and then you got to turn around and give a quarter, almost 25% of that to Uncle Sam. But if you use the QSBS election and you do it correctly, which we help lots of our clients do, you can literally save millions. So here are the rules. First, you have to be a C Corp, as I mentioned. No LLC, no S Corp. You have to hold it for at least 5 years. You cannot have more than 75 million in assets. If you do, you disqualify yourself. So just know that you can't have more than 75 million. And they just increased that because it used to be 50 and now they made it 75, which I love. They just did this like a few weeks ago. And you have to be a business that sells products, right? So if your online store or your brand qualifies, as long as you're selling actual products and software, you're not like some kind of financial service or personal consultant, you can actually qualify. And you have to have gotten your stock directly from your company. So it couldn't be like, hey, I'm buying stock from somebody who owns stock and they gave it to me and now I'm selling it. This company has to issue the stock directly. So perfect for online ecom sellers. That's why they use it so much. And you have to hold it for 5 years. So, and this is a real kicker. This applies, that 15 million applies to each founder. So if you have a wife and she owns 49% and you own 50%, each of you get to take advantage of the 15 million. Right? Nice. But make sure you consult with your CPA or tax advisor because I'm making it very plain Jane and straightforward, but there's a lot to it. So just remember that. All right. So if you're feeling overwhelmed, that's totally normal. Taxes don't have to be scary. Okay. Taking small steps like these can make a big difference, but make sure you talk to your CPA or tax advisor to put these ideas into action. There's a lot to getting all this set up the right way. And now here's some more exciting news. So first, know that most online business owners are struggling with cash flow, right? Shock horror. Yeah, a lot of them are struggling with cash flow problems. But what if I told you it's completely unnecessary? You don't have to live paycheck to paycheck in your business. Cash flow issues aren't just annoying. They're holding back your growth and keeping you awake at night, which is the worst part. And you're constantly juggling money for inventory, payroll, and ad spend while dreading those surprise attacks. Like, hey, all of a sudden you have this ginormous tax bill, or you have a penalty, or what have you, or you have to pay your sales tax, right? Meanwhile, successful e-commerce entrepreneurs have figured out how to make their money work for them instead of the other way around. And if you want to know their secrets, and these aren't complicated financial strategies that only CPAs understand, they're practical hacks that any business owner can implement tomorrow. Okay, so imagine having exactly the cash you need when you need it without the stress or the scramble. So if you join me next week, July 31st at 4 p.m. Eastern Standard Time, I'll break down the exact cash flow management system that top ecom businesses use so they're not chasing cash flow. Okay, I hope you join me. Actually, it's 2 p.m. I'm sorry, it's 2 p.m. Eastern Standard Time. All right, well, that's it for now. Thank you guys so much. Hopefully that wasn't too overwhelming. And I'm wishing each of you swift sales and sensational success. Bye for now and take care. And let me know if you have any questions. You can leave a comment, whether you're on YouTube or Facebook. You can leave a comment below and I'll make sure that I will answer them. Have a good night. Bye-bye.